You were taught that America's economy is too big to fail. The world's reserve currency, the deepest markets, the strongest institutions. But every empire believed that, right up until the moment they were proven wrong. The collapse of the U.S. economy won't start with a crash. It's already begun, in plain sight, with mechanisms most people don't even recognize. And once you see what's actually happening, you can't unsee it. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. Because the pattern that destroyed reserve currencies in the past is repeating itself in America today. Most people just don't know where to look. December 2025. U.S. national debt exceeds $36 trillion, more than the entire economy produces in a year. Interest payments on that debt now consume over $1 trillion annually, surpassing defense spending. The Federal Reserve holds over $7 trillion in assets purchased to stabilize markets since 2008. At first glance, this looks manageable. Markets function, businesses operate, life continues. But beneath the surface, something fundamental has changed. The U.S. economy no longer operates on the principles that made it dominant. It operates on borrowed time, borrowed money, and borrowed confidence. What no one wants to acknowledge is the cost of that postponement. To understand how this began, you have to go back to August 15, 1971. President Nixon closed the gold window, ending the dollar's convertibility to gold. At the time, it seemed like pragmatic crisis management. America was running deficits to fund the Vietnam War and Great Society programs. Gold reserves were draining, but that decision changed everything. For the first time in history, the world's reserve currency was backed by nothing except trust in U.S. economic stability and military power. Initially, this worked brilliantly. Without the gold constraint, the U.S. could finance deficits by issuing debt that the world eagerly purchased. The dollar became even more dominant, not despite losing its gold backing, but because of it. Oil was priced in dollars. International trade settled in dollars. Central banks held dollars as reserves. America gained what economists call exorbitant privilege, the ability to borrow in its own currency without immediate consequences. The assumption was simple. As long as the world needed dollars, America could sustain this indefinitely. It worked for him, but only under conditions that would not last. From the 1980s through the early 2000s, the system accelerated. Deficits grew, but so did the economy. Debt rose, but interest rates fell. Borrowing became cheaper even as the total amount increased. The tech boom, the housing boom, the recovery after 2008. Each crisis was met with the same solution. Lower interest rates, increase spending, expand the money supply, and each time it worked. The 2008 financial crisis could have been a reckoning. Instead, it became proof that intervention succeeds. The Federal Reserve dropped interest rates to zero and purchased $3.5 trillion in assets through quantitative easing. Markets recovered. Unemployment fell. The economy stabilized. But the unintended consequence was invisible at the time. Debt didn't shrink. It metastasized. Corporate debt doubled. Government debt soared. Household debt remained elevated. By 2020, total U.S. debt, public and private, exceeded 900% of GDP. Then COVID hit. In 3 months, the Federal Reserve injected more liquidity than in the entire decade after 2008. Congress passed over $5 trillion in stimulus spending. Markets didn't just recover, they reached all-time highs while millions were unemployed. The stronger the intervention became, the harder it was to stop. The cracks appeared not as collapse, but as contradiction. By 2021, inflation, dormant since the 1980s, began rising. First dismissed as transitory, it accelerated throughout 2022. The Federal Reserve responded by raising interest rates at the fastest pace in 4 decades. But here's the trap they created. Decades of low rates had made the entire economy dependent on cheap borrowing. Corporations refinanced debt, assuming rates would stay low. The government structured budgets, assuming minimal interest costs. Homebuyers stretched into mortgages they could barely afford. When rates rose from near zero to over 5%, the system seized. In March 2023, Silicon Valley Bank collapsed, the second largest bank failure in U.S. history. Not from bad loans, but because rising rates devalued the treasury bonds they held. 2 more banks failed within days. The Federal Reserve quietly backstopped the entire banking system through emergency lending facilities. The crisis was contained, but the vulnerability was exposed. By late 2025, the U.S. government is spending over $1 trillion annually just on interest payments. That's more than the entire defense budget, more than Medicare, more than any discretionary program. And rates are still historically low compared to past decades. Nothing collapsed, and that was the problem. Here's the moment of no return. The Federal Reserve now faces an impossible trilemma. Option 1, Keep rates high to control inflation, but risk triggering mass defaults, corporate bankruptcies, and a government debt crisis. Option 2, cut rates to support the economy, but allow inflation to erode purchasing power and destroy confidence in the dollar. Option 3, hold rates steady and watch the economy slowly suffocate under the weight of unserviceable debt. There is no fourth option. Every choice has consequences that can no longer be postponed. Meanwhile, global trust in the dollar is quietly eroding. BRICS nations, Brazil, Russia, India, China, South Africa, are actively developing alternative payment systems. Saudi Arabia, America's oldest Middle Eastern ally, has begun accepting yuan for oil sales. Central banks worldwide are accumulating gold at the fastest pace since 1950. In November 2025, China's holdings of U.S. Treasury bonds fell to the lowest level in 15 years. This isn't a sudden rejection. It's a gradual strategic diversification. The world isn't abandoning the dollar. It's preparing for a future where the dollar is not the only option. From this point on, the outcome was no longer optional. So, what happens when America's exorbitant privilege ends? It doesn't mean the economy disappears. It means the terms change. When the world no longer needs to hold dollars to participate in global trade, the U.S. loses its ability to borrow without consequence. Interest rates rise, not because of Federal Reserve policy, but because global demand for U.S. debt weakens. The government faces a choice: cut spending dramatically or print money to cover deficits. Both trigger consequences. Spending cuts mean reduced social programs, infrastructure decay, and political instability. Printing money means inflation, currency devaluation, and loss of purchasing power. History provides the pattern. Britain held reserve currency status for over a century. After World War II, pound sterling collapsed as the global standard. Britain didn't vanish, but its global influence, living standards, and economic dominance never recovered. The shift was quiet, gradual, irreversible. The same mechanics are visible today, not in dramatic headlines, but in Treasury auction results, capital flow data, and central bank reserve composition. This isn't fear-mongering, it's arithmetic. When a government spends more than it collects, the difference must be borrowed. When debt grows faster than the economy, the burden increases. When interest payments consume revenue that could fund infrastructure, education, or defense, choices narrow. Every reserve currency in history has eventually faced this reckoning. Rome, Spain, the Netherlands, Britain. Each believed their situation was unique. Each assumed their dominance was permanent. Each discovered that economic gravity applies to everyone. The U.S. economy won't collapse like Venezuela or Zimbabwe. It will decline like Britain after 1945, gradually losing its privileged position while remaining a significant but no longer dominant power. The collapse isn't a future event, it's a current process. History doesn't repeat events, it repeats incentives. Two things are certain. First, every system built on perpetually expanding debt eventually meets a constraint it cannot overcome. Second, the closer that moment arrives, the more confident the architects become that it will never happen. Because in the world of wealth and power, history never ends. It just changes hands. If this hidden chapter of American economic history fascinated you, hit like, subscribe to the Wealth Timeline, and ring the bell, because the next story could completely change the way you see power.